Welcome back to the channel. We're thrilled to have you here with us today. Today we're tackling income statements. What are they? Why should you care? Let's dive in. An income statement is one of the most important financial documents for any business. An income statement shows how much money a company made or lost over a specific period. This period could be a month, a quarter, or a year. It covers a specific period, like 3 months or a year. This helps businesses track their performance over time and make informed decisions. Think of it like a company's report card for profitability. Just like a report card shows a student's academic performance, an income statement shows a company's financial performance. Investors use income statements to make decisions. They analyze these documents to understand how well a company is doing financially. They want to see if a company is making money. A profitable company is more likely to attract investors and secure funding for future growth. It's a fundamental tool for understanding a business's financial health. By regularly reviewing income statements, businesses can identify trends, manage expenses, and plan for the future. Now, let's break down the income statement. This crucial financial document provides a summary of a company's revenues, costs, and expenses during a specific period. Understanding it is key to grasping the financial health of a business. Don't worry, it's simpler than you think. First up, revenue. This is the total money a company brings in from selling its products or services. It's the starting point of the income statement and is often referred to as the top line. Revenue can come from various sources such as sales of goods, services rendered, or other business activities. It's essential to track this figure accurately to understand the business's earning potential. It's the top line of the income statement, setting the stage for all subsequent calculations. Next we have cost of goods sold, or COGS. This represents the direct costs associated with producing the goods or services a company sells. This includes expenses like raw materials, direct labor, and manufacturing overhead. Essentially, it's the cost of turning raw materials into finished products. Think raw materials, direct labor, that sort of thing. These costs are crucial for determining the profitability of the products or services sold. Subtract COGS from revenue, and you get gross profit. This figure indicates how much money is left over after covering the basic costs of what you're selling. Gross profit is a critical measure of a company's efficiency in managing its production costs. It helps businesses understand their core profitability before accounting for other expenses. Now let's go beyond just the basics. Understanding an income statement is crucial for making informed business decisions. It provides a detailed look at a company's revenues, expenses, and profits over a specific period. 2 key ratios can help you quickly understand an income statement. These ratios are essential for evaluating a company's financial health and operational efficiency. Gross profit margin tells you what percentage of each dollar of revenue is left after paying for COGS, or cost of goods sold. This ratio is a good indicator of a company's production efficiency. A higher margin is generally better, as it indicates that the company retains more money from each dollar of sales. Net profit margin shows you how much of each dollar of revenue turns into profit after all expenses are paid. This includes operating expenses, interest, and taxes. Again, higher is generally better. A high net profit margin means the company is efficient at converting sales into actual profit. Let's look at an example. Imagine a lemonade stand. This simple business model can help us understand these concepts better. They sell $100 of lemonade, which is the revenue. Revenue is the total amount of money generated from sales. Their lemons and sugar cost $20, which is the COGS. COGS includes all the direct costs associated with producing the lemonade. Their gross profit is $80. Gross profit is calculated by subtracting COGS from revenue. Their gross profit margin is 80%. This means they retain 80 cents of every dollar earned after covering the cost of ingredients. Income statements are powerful, but they have limitations. They don't show everything like a company's debt or cash flow. They are also backward-looking. They tell you what happened in the past, not what will happen in the future. Despite these limitations, income statements are essential for evaluating a company's profitability and performance. They provide a clear picture of a company's financial health. That's it for today. Remember to like and subscribe for more financial tips. Happy investing!